introduce my guest, Stephen Kollar. Thank you so much for coming on the show. I can't wait to ask you a million questions. I don't know you very well because we found each other through LinkedIn, but it sounds like you have a phenomenal track record. Why don't you walk the audience through a little bit about your background, how you got into what you're doing, and what the evolution of becoming what you currently are was like?
Great. Thank you for having me on the show. That's the most important thing. I appreciate that because we like to share, and we were always an entrepreneur type of person. And then we had a lawn service where we had 2 or 3 people that we paid to drive. And then we had like 11 or 12 kids. And then we went out and sold the lawn service. And then we took that money and I bought a house at 729 Broadway from this elderly lady that was about 4'11". So everything above 5'5" was black. She had lived there for like 40 years. And we paid like $3,500. It was definitely a D area, but that was our indication because you don't have to be of any age to take a deed. I mean, as long as you're paying cash. So we were at 15 and we bought that. And I learned the fun joys of rental property. Why don't these people pay? Just because they tell me they're going to pay. So you got some kid that's sitting there trying to collect from these adults that, I learned about evictions and all the exciting parts of real estate the hard way. Like we talked, there's quite a bit of track record. So what I try to do is help share so some of the people don't make the same mistakes that we did and they learn by our experience. So that is one of the reasons that I try to do all this, because there's so many questions. And if you know a little more, you avoid a lot of the pitfalls and it saves you a lot of time and effort in pursuing the right in different angles. So yeah, we still have that house. It rents for like $750, and I think when I was a kid, it rented for like $350, $375.
That's amazing. So, yeah, I'm going to ask you some questions just from my own perspective, and hopefully the audience will have some of the similar questions. So you took the deed at 15 years old, and I know that there's no laws against that. In fact, you don't even have to be a U.S. citizen to get on the deed of a property. But at 15 years old, there's contracts that you sign, and I believe there's legalities of what person has to have in place to sign a contract. One of them being that you're 18 years old. Is that correct, or did you just find that?
That is correct. We did it. We did the leases. We still signed them. If I would have had to go into court and they would have come against us, they probably would have had difficulty because of being under 18. But when you're in the rental market, you're kind of in control because you're the landlord. And we didn't really have a lot of flack for that type of thing. So we did the leases and they held up in court when we did the evictions. I don't think anybody asked the age of any kind, but in retrospect, it would have been better to have somebody over the age of 18 sign, because it would have meant more if it would have been a proceeding that would have been challenged. But we live in a Republican state that's very hardcore. You don't pay your rent, you're out. It takes us here 3 weeks to evict somebody in Indiana. And that really hasn't changed over the years.
Okay, so what was it like going to school or just being that age and telling people I own real estate, I have a rental property, or I live in a property that I bought?
In the beginning, it was like where all the friends want to come over when it was vacant. They could utilize it because they didn't have to go to their parents' house. So we did a lot of that. We also had the lawn service. We did what they call numismatics, rare coins and stuff like that. We had a business in that. So once we rented that out, we ended up buying a house at 17 and moving into that. And one of the things you want to do is never buy a home close to your high school, because I'd be gone every weekend doing a show somewhere. I'd come home and I'd always find 1 or 2 friends that had gotten into the house because they wanted access to the bedroom. So it was really a situation not to have a home that was like 3 or 4 blocks from your high school.
Yeah, I'm very familiar with that situation. My mom let me live in the garage during high school, and whenever I'd be at school, there'd be people in the garage, having a big party in there, and I'd get back from school or back from work, and they'd already be, doing all kinds of crazy things that we won't go into in this show. But I know what that feels like.
In high school, you ask what it's like. Because we had the rental property, we had other things going on. It was mostly, working all the time. We didn't do the typical high school things. My parents always said that I kind of missed my whole teenage years. I mean, somehow I just went from kid to like adult, where we started having, a store and the properties because we kept acquiring more properties as we went along.
So how many properties did you buy before the age of 20?
23.
Wow, that is so insane. I can't even imagine having that mindset. I didn't get into real estate into my 30s, and I talk to people that are in their 20s, and they're so sharp and so interested in creating their portfolio at that age, and it's so astounding to me because I just didn't have that mindset. But take us through the process. You start buying properties. You have 23 properties at age 20, and then how did you were just buying rental properties, or were they fix and flips? What were you doing with them?
Basically all rental properties. Indiana's a little bit unusual because we have a lower housing value here. And what we got into was the C and, B minus type properties. So they're not really great for the flips, because if somebody can qualify, they're going to buy a more expensive house. The typical American doesn't buy the less expensive house. He buys whatever he can qualify for. So most of the homes that we were buying were always on rental properties. And back then, again, 30 years ago, a lot more land contracts were done, a lot more owner financing. So, you could go in and buy a home for, 10% down and buy packages. Because most landlords would, if you hit the older group, they'd be tired and ready to go. And you would sit down and you could give them 10 grand and buy 4 or 5 properties on a package, because they were ready to sell them. And back then it was tougher to get owner or any type of bank financing for single families. So you had to be very creative back then.
Yeah, I like creativity when it comes to financing. I love seller finance. I believe seller finance is better for the seller than it is for the buyer in many cases, if not all, because the seller financing turns them into a bank. So now they receive passive income without actually having the headache of property management. And there's all kinds of other benefits, including tax benefits, so that you're not paying a large capital gains up front when you seller finance. It's more over time.
But
But
see, that's
so
the big,
go ahead.
oh, that was the big advantage of doing the JV deals and not doing the syndication. You have a lot more flexibility with the owners. You can take down part of it, you can leave them in, you can help them do a 1031 exchange, or you can help them move into an opportunity zone. Because most of the people that are selling a lot of times don't need necessarily the capital. They're looking for that income stream. And like you said, if they're in a high tax position because they've owned it for a long time, there's a lot more creative ways that you can work with them when you're a JV than so much in the syndication side of it.
Yeah, so let's talk about that, because before the show, Stephen mentioned that he does multifamily properties, and I let him know that typically I deal in the world of syndication, and that I'm not too familiar with joint venturing on properties that are 100 units and up, nor do I know really all of the benefits, but you started to mention some of them. So what is the mindset of somebody that joint ventures into these 100-unit properties versus what you see from the syndication side? And tell us about some of the benefits and why you do it that way.
Some of the greater benefits is we can move much more quickly than the average syndication if they've got to put the money together, unless they have a war chest accumulated. We have a lot more flexibility on terms because there's just a couple people involved. Lending today is different than it was 5 years ago, and will be different 5 years from now. There's a lot of money out there being able to chase the deals, so you can structure them much easier today than you could in the past. The purpose of syndication is raising large blocks of money. Well, the leverage out there now is 70 and 80% in buying some of these projects, and there's so many lenders chasing so few deals. You can really creatively end up owning a much larger percentage of a transaction than you do in the syndication side, because your partner is the bank. So therefore you're keeping more of the upside when you do it. And you have that flexibility of moving much quicker than what you do in a much larger situation. A syndication will beat us if you're accumulating 10 or 15,000 units because of the capital. But when you're in and out of project, it's 1 to 500 units, you can move much more quickly.
I would have thought that the joint venture partners would get a bigger percentage of the deal than they would in a syndication. Has that been your experience or the opposite?
Both. I mean, depending on how you structure it, some of them are looking for the equity, some are just looking for some income. But you're getting the banks to pony up between 70 and 80% of the transaction. So now the 20% there is still 100% of the company. So how you divide that equity up is open, depending on what their participation is. Today, not other times, since there's more money involved in deals and the people that execute them, the money doesn't carry the weight it did 5 years ago. 5 years ago, you were much more at the hands of the lender who had the money. Today, it's not that way. And it may change in 3 to 4 years. You got to be fluid.
Yeah, absolutely. It can be challenging if you're not able to adapt to the market changes. I actually got stuck in that and got caught. I was investing really well during the crash, and then as things changed, it started becoming a lot more challenging for me, and I didn't adapt as quickly. But I'm back. I think when people have a focus on real estate and enjoy it, they eventually will find their way back. I know a lot of people that lost really hard in the crash, and they have found their way back. Some people are still on the sidelines.
I
But
mean, back we had Regency Bank and they had made commitments to take us out of hard money. And we were able to meet the criteria. They kept changing it as the market got tighter. We finally met the criteria because they were up in my levels for permanent financing. We got it done. We went in on a Monday. There was 28 people in the Regency office. When we got there on Monday, there were 2. They had let 26 people go. And they looked at us and I said, well, I've got a loan commitment. We've got all this done. They just looked at us and say, sue us.
so I have a friend, his name's Brian, and he offers notes. He does new construction homes. He does multifamily. He does syndication. He does a variety of different things. And he likes having different options to present to investors because he says, Ruben, if the only thing that you have to offer is multifamily syndication, you're going to be shoving that down a potential investor's throat. And maybe they don't want that long-term commitment. Maybe they want different styles of opportunities that they can invest with. Now, for you, I know that you're in multifamily and you're doing a lot of single families. Tell us a little bit about what you prefer. Is it more multifamily? Is it both? Do you like the flexibility of have different options for your investors? What's your mindset behind that?
My mindset is the deal. It's the flexibility of the multifamily or the single family, depending on what the transactions are. Therefore, it's just like a net. If you're looking for 2 different type of fish, when you're out there, you're going to be able to cultivate those. So we push for the deal, the transactions. We're always working with whatever lenders, banks that we can get ourselves into, asset managers to find potential problems. We'll read about one instance, we're trying to acquire 180 units here. They're having trouble with code enforcement, absentee management. The managers they've hired have not been good. That's a target. Anytime you see a problem, that's the type of target that you're looking for. Even when you're out working, you got bird dog guys type looking for stuff. The complex starts slipping. There's a reason. Either management's slipping, capital's not available. This is the opportunity to step in because the trick is getting it before they bleed it down to nothing. So you want to step in while they're just now starting to bleed. So therefore, when you try to turn it around, it doesn't take nearly as long. So to answer your question, we like to have quite a few different options available. Like we're looking at 100 or 200 unit in Montgomery right now. That's a value add. They're asking like 20 grand a unit.
Wow.
Looking at that one right now.
How do we get in on that with you?
Yeah, that conversation, which is what, if your listeners do when they're talking to the broker, try to be as open as possible. We were looking at a trailer park in Toledo, Ohio, that was 370 units. And we started talking and, he wanted to know what we did and we talked about it. And I told him about problem deals. He brought up the deal in Montgomery because the buyer was having trouble getting it closed and the owner wanted it gone. And it appeared to him that the buyer was going to fail. So the owner is very motivated to get out. So if we made him an offer when that contract falls apart, he's going to be very susceptible and probably would take maybe 3-4 grand a door less to get it done. 3 to 4 grand doesn't sound like much, but if you take it times 200, it becomes a lot of money.
Yeah, absolutely.
So we already have single family houses in Montgomery, so it just happens to work out that that may play out.
Let's talk about your portfolio and how you've built it over time and what it consists of.
A lot of blood, sweat, and tears. Acquiring different deals at times. I mean, we've done the HUD deal where they completely paid the people $3,000. This was on a 258 unit we did in Indy. They paid every 10 to 3 grand to move out to leave it rent ready, type setup, broom clean, because they were foreclosing. And HUD is a, I don't want to say it's type challenge. When they foreclosed, they left these guys in there for like 23 months without making any payments. Came into this complex, 2 leasing agents, 2 maintenance guys, security people there, and there's no tenants. But this is HUD money paying it. So we bought it, and the story of the thing is, they paid 3 grand, so these units would be really nice. Out of the 258 units, there wasn't one unit that we could rent as it was. But they paid all that money out. So the point of that conversation is you really got to do your due diligence. Because the paperwork they sent up here was just, it looked really great. But when you got there, it was a much more challenge. So that's how we acquired that. Other deals have been through the banks. And then sometimes you'll get with a few people, if you start networking enough, they get tired and they want out. Their changes, their family structure changes. It's consuming too much time. The people that are on the sidelines of the syndication, they don't feel the pressure or the involvement that the apartment complex has, so it's more difficult to buy from them unless they need money. Because if you're dealing with some of the people that are involved, then it's easier to deal with them because at times they feel like it and they'll want to get out. I mean, the biggest trick in this game is networking and just making everybody that you know of aware that you're looking to acquire something. And the other is
that's a phenomenal point. I want to stop you right there because I believe network is the most powerful thing that you can do to raise capital. What are some of the tricks? What are some of the techniques that you use to go out and meet people that can help you in your business?
You mean as far as money coming into the table or us doing acquisition? Because
it's a combination of both of those things.
Acquisition is, there's like 4 major personality types. And as you can tell, I'm more the outgoing type of individual. When you're at the networking events, you start looking for the introverts that are looking to acquire some complexes because you're going to find that they're usually very well heeled. Everything they have is perfectly aligned. They usually have very strong credit and deep pockets. Guys like us, they need to help put the structure of the deal together, do the ramrodding, go in and get it stabilized, where they're much more of a better player when it comes to once it's stabilized and keeping it going. You're out of the shows, you can spot that type of personality. So a lot of times we'll team up with those type of individuals because I know what they're looking for and they're not going to keep knocking on the doors till they find it. But once you set it up, structure it, send it into the kill bin, they can usually run it from that point. So we use personalities in the networking a lot.
Yeah, that's a great concept. I had never used it on purpose, but I found myself in front of a few introverts at a networking meeting yesterday, and there were some opportunities for business there. I had never considered personality types as part of the equation, but you're absolutely right. What are some of the best techniques that you use to raise money, or do you even look at it that way? Is it more about presenting an opportunity to somebody?
Where it's more about finding the opportunities and then have already, there was Harvey McKay, it's probably before your time, it was dig your well before you're thirsty. So when you go into these networking events, you'll find people that, hey, if you run across something, you need to touch base with them every couple months, even if you just say hi. Because if you call a guy after 8 months and say, hey, I found a deal, your personality traits, they're like, why are you calling me after 8 months? But if you at least you stay in touch with them every couple months. So going back to that point, you're networking all the time to find the people that can sell you the deal and the people that can go in with you to help capitalize it. And as we discussed earlier with the brokers, we let them keep both sides of the equation, and we tell them right up front, hey, we can close this, or I'm going to need 90 days, or we've only got half the fund raised, so they know right where you're at. So they know if they call you on the phone, they're going to get a straight shot right at it. They also know the numbers have got to be good if they call us. But what it helps them for is they know they can close. If we sign, we're going to close. And that's the key thing, because they don't get paid unless they close. So when you're out networking, it's just important to be upfront with them and say, hey, we can handle a deal between 100 and 300 units. If you brought me something that was 700 or 800, and if I had a week or two, I could make some calls, then maybe we could put it together so they know what they're dealing with.
Yeah, I talk to people every day. Some of them are brokers and they want to start sending deals my way, but I'm not sure if it's usually a fit. And then I get these other guys that are very focused on these little things, and they're always trying to sell, and sometimes they're focused on their own commission rather than the opportunity they can provide, but they're still trying to sell, sell, sell. And
That's more than you want to give them credit. There's more people that want to sell and earn the commission than want to bring you a deal that's advantageous.
yeah, and that was one of the things we mentioned earlier before the phone call, that in multifamily syndication, a lot of the gurus and a lot of people with some experience are saying, if you have a real estate license and you're in syndication or want to do syndication or looking at deals in that arena, then let the broker who finds you the deal keep the entire commission rather than taking a referral, because this is the lifeblood of their business. And if you're taking a percentage of what they earn on that, they're less inclined to keep sending you more deals, because they can send them to other people that don't participate that way in the referral program.
Well, let's look at it through human nature. We can skip all the hype for right and wrong, but human nature is, if he can call Ruben and he's got to split the commission on a $2 million deal, let's say it's 66%, so it's 120,000, or he can call me and he keeps both sides, who gets the first phone call? Unless you're like right next to him and he's your best bud, he's going to make $60,000 more by calling me.
Yeah.
Human nature says, who's going to get the call. Then when there's people that will let him keep both sides, it's who's the easiest to work with. Who do I know that, I know when I talk to them that they're going to tell me this straight up, and I don't go through 90 days of trying to get it financed and they can't finance the project.
Yeah, let's go back to the 1,500 houses that you've done. Are those all still in your portfolio? Or is that your existing portfolio, or the amount of deals that you purchased over?
That was the amount of deals we did. We sold a lot of houses through 04, 05, 06, 07 because there was a lot of demand for the rental properties. Now that was me. Now the company I work with, we did about 80 single family houses in the last 60 days. And
80 in 60 days.
Yeah, these are buy to rent. We do the build to rent, and then we also do the rehabs. Well, you got to remember, there's a lot of money coming out of the the West Coast into the Midwest because they're getting such high numbers out there. They're bringing it to the Midwest because the Midwest is boring, easy, conservative, and usually just always pays a first base hit. We don't see the ups and downs that a lot of things, because we have a strong workforce housing here.
Yeah, that's one of the things that a lot of people are focused on. Bakerson, in fact, is particularly after workforce type of residents for their apartment complexes. And you're right, what I'm seeing, even in Phoenix, all of this Chinese money, Canadian money, institutional money, California money has driven the market here in Arizona, even though we have strong economic factors and growth and drivers. There's just not a lot of deals to be had because everybody's buying them up. It's challenging to find a deal. So we ourselves are starting to look into other markets. We got a couple in Houston that we're looking at. We're looking at Oklahoma, Texas, and New Mexico. We want to get out into the Midwest as well. We want to look at the sun belt down in the Florida, Carolinas, Georgia, Alabama, Tennessee, because the deals are just a lot more profitable in those areas than they are here. I mean, at least in terms of returns for your investors. Now, so with the 80 houses that you're doing, you're buying a bunch of properties, single family dwellings, and then you're buying multifamily. How do you manage having both sides and going after both types of deals? Is it pretty
Because
easy at your
it's
level of
system, everything's based on McDonald's. You know, we try to do the systems. In the beginning of Innovation Homes, which is the largest player in the single family market, they've got about 78,000 homes. They're the Blackstone group. What we learned from them when I was sitting down over dinner one time was they manage everything by a trough system. If it goes down to where it's supposed to, that's left alone. And if something falls out of the guidelines, then you get it. So for example, like on the rehabs and things like that, there's budgets and procedures. And the only time that we try to get involved is when it goes outside the lines. If it kind of follows within a few marginal points, it just goes. I mean, we use the same colors, the same vinyl plank, the same fixtures, the same everything that we use. You know, we have a bunch of SKUs that we use out of Home Depot, so it's the same vanity. It's just basically taking the same project and doing it over and over again. It's not a real complicated formula.
That's the key to having a successful business is just mastering it in such a way because you're doing it over and over and over. That's how we were doing it. Reminds me of my old real estate partner. I used to ask him, how are you finding these deals on the market? And he said, well, the reason that we can buy these properties so cheaply, so effectively, and so efficiently is because this is what we're doing every single day. We're going to property after property. And a lot of times we can just look at them from the outside, just maybe 3 or 4 minutes go inside and know whether or not we're going to make money off of it. So it sounds like you have a dialed in system, and that's phenomenal for your business. Now, what about these properties that you're doing? Tell us about the relationship that you have with the investors that are helping you purchase these deals.
We make the ones that are helping us purchase, you just take, well, you know, it's communication. You know, we use a lot of the Google Docs. We share all the information. We're very transparent, so they know exactly where they are. They can have as much or as little involvement as they want. In the beginning, they have more involvement because you know they're not as comfortable with you, and as time goes on, they get more comfortable with us.
So these guys, are you finding new investors that are coming to you saying, hey, I want a piece of this action. I see that you've been a player in this business and you have a great track record. Let us invest with you. How does that process work? Or is it just money that you go and seek yourself?
A little of all of it. Like, for example, we'll be selling somebody a couple single family houses. They like the way we do it. And as you see, we talk a lot. So when we're talking, yeah, we're working on this. Well, hey, can I get into that too? Because they see how you manage their, you know, their few houses that they bought. And then sometimes they'll step in for a bigger piece of the action when you're out looking at a deal. Because the stuff we're buying is that value add stuff. There's something wrong. Either bad management, no capital, they want out. Something's got to be that precedent to make them want to sell it. So there's a little bit more involved when we go into the project.
At this point, have you written a book about investing in real estate? It sounds like
No, but some of the old timers that Peter Conte told me that once you write the book, it isn't really for you. It's really so that it gives you credibility. And he said, you know, he's got 8,000 of them. I don't know, he had like 10,000 printed. He says, I still got 8,000 of them in my garage. But when I go and I do an event or show up at one of the seminars for doing things, if they see that book on the table, they automatically think that you're the expert. You know, so it's not as complicated as people think it is anymore, because a lot more people are writing books, and it's just to give the author more credibility than it actually is to enhance the profession.
Yeah, I would say that that's one of the things that is being taught by a lot of different places is to create the image of being an expert. So when you run a meetup, the person that's in charge of running it, they automatically have an authority figure. If you have a podcast like this, one of the reasons I started is not only for the branding awareness, and to share, but so that people would be able to see me as an authority in this arena, even though that may not be totally the case. I'm fortunately enough able to lean very heavily on a real estate team that has a great track record, but they don't necessarily have the exposure. So this is a great avenue, doing a podcast, doing a YouTube channel, writing a book like we were talking about earlier. All of these are great avenues for getting people to see you, to get out in the limelight so that they focus in on you. And then if they know, like, and trust you, they'll invest with you. But if they don't know you, I mean, they can't like or trust you. So that's one of the things, is how do you get your brand awareness out? How do people find you? Because you want the people to come into to you. You don't necessarily want to go hunt these people down. If you can get them to come after you based off of, they say things like, I see what you're doing, I like what you're doing, you sound proficient in it, how do I get involved? That's a great place to be, rather than you going out
Very
and,
true.
and tracking these people down.
Because like when we were at the IMN events, they attract a little bit more of an upscale type of attendee. I mean, he's coming from the hedge funds or coming from family private wealth offices and things like that. So when we're up there and we're speaking, usually it comes across that we know what we're doing, and then a lot of times we'll get approached. We were working on a 600 deal portfolio out of Indianapolis because somebody with too much money had gotten into the projects and got sold a whole bunch of goods, and somebody else had to come in and clean it. That's one of the things that we've been setting our, going back to our groundwork when we talked about digging your well. There's a company called Genesis, which is owned by Goldman Sachs. They'll only do like 20 to $40 million deals. I mean, theoretically, they'll do 1 million, but they're not very helpful at that level. But we foresee a lot of these hedge funds that have not been able to manage their portfolios as well as they have claimed they did. And I think there's going to be opportunity in there because managing properties is difficult. It's not an easy science. I mean, it's like anything else, doing a heart transplant is hard unless you've done it most of your life. So in that sense, I think some of the portfolios, I think, are going to become more available as the water goes out and you see the naked people. I think there's going to be more capital calls coming up with the market where some of the lenders are going to say, hey, you've leveraged us to the hilt. We haven't seen the appreciation numbers that you guys talked about because there's a lot more money coming due from, 11, 12, a lot of the 5-year notes. I don't foresee them being able to want to come up with that capital. So we've been targeting a lot more of the banks and the lenders, which is say, hey, if you have a problem, we have a lender that will loan us on mortgages. So we can come in and say, hey, Mr. Bank, we'll pay you 70 cents and we'll take your mortgage. And then we'll go work it out with the borrower. Because what we can do that the banks can't do is I can say, hey, I'm going to take this property in 15 to 16 months, even if you fight me with bankruptcy. Take my 60 or 70,000 right now, quit claim the deed to me, and then you can walk. Or you can fight me in court and bleed it out for another year and suck out the revenue until I can get you out through a foreclosure. Because a lot of times what people don't understand, there's enough money involved that you can throw a large complex into some type of bankruptcy and then to be able to utilize that money and stretch it out for 15 to 16 months until the lender can actually physically take it back. So that's always a risk when you're doing this.
Yeah, I want to get into that topic a little further. Before we started recording, you had mentioned that you're creating relationships with banks because you foresee not necessarily an economic recession, a full-blown recession, but that you see that there's going to be a lot of notes being called and some people that are going to be getting into trouble in the next few years. Interestingly enough, I just came from a conference where they took some successful multifamily guys and they took 3 of them and said, hey, you guys pretend that the market is all peachy and everything's going to be great for the next 3 years. And then you 3 guys say everything's horrible. There's going to be a mad recession coming up forward. And then you guys debate on what are the benefits of investing in multifamily right now. And you guys come from the perspective of don't ever do it because there's the sky's about to crash. And it was an interesting communication because they they had to step out of their comfort zone and talk about why they could potentially foresee something happening, even though that's not what they believe. But your belief system, or the things that you're preparing for in case they do, where do those thoughts come from, and how are you creating a relationship with banks so that you're ready to capitalize on that?
By talking to some of the lenders that they were worried and concerned, because what people don't understand in the multifamily business and the professional players, just like in the hotel game, instead of selling the project, all you do is you go re-leverage it. Because if you pull money against the project, there's no taxable income. So if I paid $2 million for something and it's now worth 3, I could go out and borrow that other $1 million and I have no tax consequence. I still have use of the money, but I have no tax consequence. So a lot of the hotels and the multifamilies with the professional players, they'll lever the property up all the way to the hill so that they can pull that money out and have use of that money. So when times get a little bit tougher, or the banks say, hey, you know, we want to be at 70% instead of 90, and they do a capital call, a lot of these people are going to say, hey, we're not going to pull the money back into it. You know, each deal will be separate, but a lot of them, one, they're not going to be able to throw the money back in. And two, a lot of them will just say, hey, we'll walk away. So that's why I see, and talking to different lenders, they foresee, and they're telling me that they're concerned. So what we did is we went out to find a lender that would loan on mortgages, which is an exception because you really got to know that market. So now we have a way to lay off our mortgages. A mortgage transaction is much different than buying the complex, because it can close in one day because it's just one assignment sheet of paper saying, hey, bank A assigns it to, you know, lender 2 or company 2. It's a one-page transaction. So it's really simple and quick and clean. And a lot of lenders don't want to be the bad guy by dragging it through foreclosure and all that stuff and having their name appear that they're the ones doing all the foreclosures. So some of them will take a 20% haircut just to get out of that whole plan. You got to remember, the bigger the lender, the more expensive the legal fees, you know, because they got to hire different size of corporate accountants for the different size of lender they are. You know, the larger they are, the higher rating they're going to have for that attorney.
Do you think, because I know in syndication, they typically don't like to leverage because they have people's money at risk. Their investors' hard-earned money is at risk, and they don't like to get all the way up to 100% or max it out to the hills in regards to the leverage on the deal. Do you find, because you specialize, or not specialize, but the more of the deals that you do are joint venture type of deals, who are the guys that are taking out the most amount? Is it people that own the property straight out, and those are the guys that are going to cause a lot of problems in regards to giving money back to or giving deals back to the bank? Or do you see that it's coming from all angles, syndicators, joint venture people, and mom and pops that own property for generational?
Not so much mom and pops because they're not sophisticated, and usually they're making enough money through the cash flow. They don't need that capital and they don't want to borrow it. The syndicators, if they're the more sophisticated they are, the more chance they'll go back and re-lever it up because they can use it on other complexes, you know, because it takes a little bit more knowledge to re-lever it up and convince all your syndicated owners that, hey, this is the best thing and we can take the money and move it up. And then the small partnerships, they do it the most because it's easiest to lever it up. You know, like, for example, 3 months ago, we were at Miami at the IMM talking. I mean, there was 15 lenders there that could loan on multifamily. 6 years ago, you might find 2 or 3. I mean, you were chasing that lender to get him to do something. Now you've got 15, 16 people that all have the money, because it's all Wall Street money, coming in and trying to get the loans. So, I mean, instead of us borrowing and begging 5 and 7 years ago, now you've got people calling probably every other day saying, hey, do you need any cash or any money or things of that nature? Because they have a large pool of money that they have to get placed.
I had a conversation with somebody from New York that runs a hedge fund that was looking to place money into apartment complexes. And typically, like you said, a lender will go 70 to 80%, 80 on the very high side, typically more in the 70 to 65% range. And he said, we'll help you acquire these properties. I see that you're doing multifamily properties in Arizona. We'll give you the money out of this fund. We are the fund. It's not like we're placing someone else's fund money and moving it. We will help you with a bridge loan. We'll help you uh, acquire this property. And I was just like, wow, like how do I get a hold of these people that are just so willing to give you money on these apartment complexes? It seems like it's not a typical thing. And then like a few minutes later, I got another message on Instagram, and then a few minutes later, I got another message saying almost the same thing, like, "Hey, we have money for multifamily. We have these terms." And I was like, "Wow, this doesn't sound right," because I'm used to a few years back how challenging it was to get financing for multifamily. Maybe even back then, or I should say, not people, but banks were defaulting, or not defaulting, but their borrowers were defaulting on apartment complexes, which were opening up a lot of opportunities where you could just go and negotiate with the bank and say, "Hey, we'll take over this note if you discount it, short sale it," and then you could do ridiculous stuff here in Phoenix back then, like take down a package of 40 duplexes for like just a little over $1 million. That would have like it would cash flow astronomically. Anyways, with that being said, I know that you're selling. I want to hear more about your single family portfolio, and what you're doing with it, because you're doing 80 houses in the last 2 months. What does that model look like, and how are you using it to
That
make
model is
money?
basically using the houses in Huntsville, Montgomery, Birmingham, Atlanta, and in St. Joe County, South Bend, which is basically Notre Dame. So what we're doing is we're rehabbing them to a little bit higher standards than normal. And because you're having a lot of that West Coast money, our average house is like 120,000, 110. That's renting between $1,200 and $1,400. I mean, we have $90,000 houses that we're doing that will rent for $1,000. We make sure property management's in place because, as you know, to acquire a new customer is much more expensive than to keep the one that we have. And if we sell a house, usually through good management, that person is worth 4.3 houses. He'll either refer, he'll buy, or something, because we can usually figure every contact that we get and make a sale is usually worth 4.3 houses. Therefore, if you take good care of them, they keep buying. So they're basically, through webinars and stuff like that, they go in, they look at our website. Right now we're short of inventory. I mean, it's just under ROI Turnkey Properties. And basically what it does, as soon as we've been putting stuff up, it's getting consumed. Because again, there's more buyers today than there is sellers. Because so many of the markets, like we're going to pull out of Huntsville because we can't offer a product that they can do well on. There's no sense of buying a $120,000 house to rent it for $1,000. Because the economics, if one thing goes wrong, there's no cushion. You try to stay within that 1% rule. So if you're buying it for $150, you're renting it out for $1,500 a month. So therefore, we're pulling more of our resources out of Huntsville and now focusing them up here in South Bend.
And your strategy, Stephen, is to buy and hold these properties?
Now, for about every 7 houses that we sell, we can keep 1. So basically, we have to sell the 7 to keep 1. So, I mean, we would hold a lot more, but, there's always capital limitations on what you're doing. So therefore, that's how we had set it up. We have one fund we're closing out that at one time had 400 to 500 houses, and we sold some of that off. That was before I got there, they put that fund together back in 2012, 2013. But I mean, a lot of it sold out. A lot of stuff in Atlanta, back during the crash, I mean, you were buying stuff that incredibly 40, 50 grand that's worth 250 now. But now you have to target the different areas, and you got to know where you're going.
So typically, do you have one investor on every deal that you do, or is it a pool of
For the single family, yeah, there's just one investor. On the multifamily, there's either somewhere between 3 people and probably 23 people, 24, I think, is in that other deal. All right, so like 3 to 24.
So once you have above 3 people and you're not doing a syndication, how do you legally protect yourself and all of the people involved?
In LLC, it allows 75 members. They've changed that rule. It used to be 35 members. Now it's 75 members.
But have you never been approached by a securities lawyer saying, hey, these people are
We're not,
passive?
the way that it's been solicited, I mean, we're not out there advertising, and most of the people that we do are accredited. And because of how the way we do it with the single family and stuff like that, it's usually like, hey, I've got some single family, let me get involved with one of the multifamily. We're not running ads out there soliciting money.
It's money from your relationships.
Yeah, I mean, that's the key. It's relationships. And again, that's how they trust you. I mean, they buy one house at 100 grand. They see how you handle it. I mean, no house goes perfect. I mean, there's problems, but the people are more concerned is how does he handle the challenges? Okay, he handled that eviction, or if a tenant does a lot of damage or whatever. Anybody can fly the jet when all the engines are running. It's when you run into a little bit of problem and one engine quits, can you still pilot the plane? Long period of track time, we have that track record of handling the problems. Because, the real estate is cyclical. Right now it's a seller's market instead of a buyer's market because there is too much money. I mean, look at the deal that just closed in Germany. I mean, it had a negative interest rate on their T-bills. I mean, what we as investors don't understand, because it's not our world, if you get up into the higher levels, the companies and the sovereign funds that have 4, 5, $600 million, those people are having entirely trouble placing that money to where they can put it. Like the last T-bill auction, I mean, it was oversubscribed like 10 to 1, where there's just so much money chasing, that return. So that's what the average people don't understand. I mean, there's two different spheres here. There's us down here borrowing 3 to 10 million for a project, and there's people setting, that are in charge of 4, 5, $600 million. How do they place it? It's a different world, and you got to look at it. But there's so much money on the sidelines. How do they bring it in? Interesting thing. We do the opportunity zones. You're familiar with those?
Yeah.
Okay, so we were at an event and we were talking. And there was a girl that she was the head speaker, and there's like 3 of us on the panel. And we're talking. I said, it's a little bit more difficult to raise, the $3 to $9 million, to do the projects because you got to find the right people. And it's the first time I've ever been disagreed with doing probably 50 panels. She goes, well, Stephen, I think I disagree with you. I think there's so much more money out there chasing deals. And I think as the time frame goes down, the funds are going to have to pick the worst of the deals that are left to be able to place the money, the money. And I mean, she's probably wearing a $3,000 pair of shoes. I mean, she was 100% Wall Street type person. And so afterwards, I mean, I've never been challenged like that. So we talked a little bit, and I had one deal that a friend of mine had that was $40 million. And she looked at me and she goes, well, Stephen, you seem like a good guy. I'll ask, but I'm not sure we can go down that low. Our minimum deal is usually $100 million. I mean, it's a different realm because that's where she comes from. I mean, she was a derivative of one of the JP Morgan funds or something. I mean, they've got $1 billion they're trying to place in the opportunity zone. They're not going to find it. I mean, those type of deals are rare and far between. And I mean, in my world, maybe not in yours, but $40 million is a big deal.
That's definitely way bigger than I'm used to. Yeah.
She looks at me, she goes, Stephen, I'll ask, and you seem to be really good, and I'll see if I can get him to go down that low, but it's usually $100 million. Yeah, okay. I mean, it's just different world in what we were talking about. But you've got to look at the whole world, and then you learn like what kind of money is setting out there. People got to understand there's different times and talks. But that big money is what's pushing that hedge fund that's calling you to get involved, because they can borrow the money at 2%, 2.5%. And if they can place it with you and just make 5 or 6, they're doubling their money. That's why they're on the phone saying, hey, do you have any deals? Because they got to get it placed. It does no good to sit there at 2% if you can't get it placed reasonably safe. And that's what the average people don't understand, is the fact that it's just different worlds for the money. But the big lenders and things like that, they're borrowing money at, I had a friend of mine in Nashville that does upper end flips. And I mean, his bank just gave him a 2 3/4 line of credit on like $1 million on his house and stuff at 2.5. They charged him $600 to close the deal. I mean, we don't ever hear that type of money. Now, granted, he's a great credit risk and all that, but the problem is the banks are having so much money sitting around, they're just trying to get it out.
Tell me
So,
about this event that you're going to. You said it was the IMM event. What is that?
yes, Information Management Network. It's basically designed for multifamily and single family houses. They have like conferences around the country. There's usually about 1,500 people that go to these events, and they're usually a little bit higher on the decision maker. I mean, there'll be one on like family offices and placing in real estate. The one that we're going to in Chicago is like I'm speaking on value add, how to add value to your project so that it returns investment. There'll be people talking about, debt restructuring, what the coming market is, what the trends are using, HUD loans, using some of the other lenders. I mean, they're basically conferences. They probably have them about once a month somewhere in the country, and they're tailored strictly for the single family and the multifamily thing. I mean, Steve Grainer's the one that runs that. He'd probably be a great guy for you to get on, because he has all these different events that appeal. I mean, just like when you and I get on something, we're good at it. They're good at hosting events in the real estate market. They just basically pick and choose around the country, and they host their events, from property management to 1031 exchanges to private family offices to the hedge funds. Like we talked earlier, I mean, Innovation Homes, which is so far out of my league, it's unreal. I mean, they got 78,000 homes. They're there on one panel. And then there's other guys like us that are much smaller. So they get a broad mix of the different people.
Yeah, I'm going to have to go check those out. I hadn't heard of those. And if I have, it's been many years, because that sounds familiar, but I just not in my recent space, not since I've come back into
like in Phoenix, when I was down there in December, there were 1,500 people there, 3-day event, and you never seen a pair of blue jeans at the event. That kind of, it's just more of a dress up bit. And in Phoenix is not the place that usually they dress up a lot, but it's just, business casual, but it's just a concept of who's there and who's coming to the thing.
Yeah, I definitely got to go. All right.
I think you would enjoy it.
Yeah, it sounds like it's be right up my alley. I love stuff like that. I love networking, getting the Bakerson name out, and then just meeting people. I mean, one of my strengths is creating relationships and just talking to people and finding out what they do and how they're adding value in the space. I want to give people an opportunity to find out how to connect with you. I know that you're on LinkedIn. I'll put a little link so that they can find you there. But where else? What's the best?
They can go to roiturnkeyproperties.com, and then they can see our inventory that we have across the country, and they can see what we have. And then we also have realestatenetworkus.com, and that's more of the different projects that we're working on. So they can pick at either website, or they're free to always call me. I mean, people tell you never to do this, but my cell phone's 574-532-3000. You can call me and ask questions. But again, going back to the networking, we talk, I'll get a lot more calls from the introverts, the accountants, the actuaries, and they'll ask me something, or they'll have a problem with one of their projects. And if we help them fix that problem, they're always there like, well, let me know the next deal that you're going on to. Mm-hmm. Now it's give before you get, because we're usually helping them with a problem. And then they'll come back and say, wow, he really knew all the answers. Let's see if we can do something with him next time. Or they'll bring us a project that, may be too big for them or too much problem. It's just, if you're there to help people and give them answers, it just creates a camaraderie that people feel comfortable and say, hey, next time we're going to do that.
Mm-hmm.
And even if it's somebody with an alpha personality like mine, they might say, hey, I got something in Indiana because I don't want to leave Florida or whatever. Because like the complex that we rehabbed in India, I mean, I gave up 10 months of my life doing that $6 million project there because we're there all the time. When you got 50 grand going out a week in payroll, you better be there to make sure it happens, because it's not something you can write a guy a $150,000 check to be the project manager, make it go all the time. For example, that indie project, we had a lot of Hispanics. It was funny because some of the kids from Purdue came by. We do a Purdue deal every year where we'll take some of their engineering students and let them work with us. The professors like it because we just throw them to the wolves. When they go to a lot of the big engineering firms, they get put in this little box, like this is all they can do. We just throw them right in the middle and say, hey, this is real life. This isn't textbook. So the 4 kids are there at like 6:30 in the morning, and one of the girls looks over, because we got probably 40 Hispanic workers. She goes, how are you guys going to get all these people here at 6:30? I looked over at her. I said, I'll have more trouble getting you 4 here than I will any one of those 50. Because they just don't understand the different working methods. And it's interesting, but they help with our process, because they help streamline things because they're engineering backgrounds, and they'll find ways to do things better. And then we also teach them about real life. It's not a sheet of paper. You got a bunch of human factor. Somebody stole all the vinyl laminate. Well, you better figure out, because you guys are going to be here to get paid, where you're going to get it to replace. You can't just say, well, sorry, you don't get paid today. Well, you don't see them tomorrow. But that's just real life. And, they're from textbooks. They don't put that kind of stuff in the textbooks, so.
What are a couple of things that you'd want to tell the audience when it comes to raising capital, whether they're a beginner or scaling their business?
First, don't be afraid to fire your investor. Because if you can't get around or you can't get along and it's a problem, he can poison the whole well for everybody. The other thing is, be as upfront and as humanly transparent as possible. People may not like what you tell them, but if at least they know they can always get the truth or the problem, they'll call you back. They may get mad on the phone, but 2 weeks from now, they'll call back and say, okay, I think this is the best way we can do that. So the trick here is give them bad news quick, so work with them and keep it transparent. Let them know what you're doing. They know you're not doing this for your health. So don't try to hide the fees or the percentages or any of that kind of stuff, because if you do, it comes out of the end. You can tell somebody that you're charging them a lot or doing the fee. If they hear it up front, there's no problem. If they say, hey, you're getting paid on this and you didn't tell us that this was your company, they feel like they've been deceived, and they start looking for problems. You don't have enough problems all by yourself without trying to hide it. And the trick here is just, be upfront and tell them where they're going, so that they feel, and, like anything, don't overpromise, tell them what they could be. Give people highs and lows. They don't, technically a lot of your syndications will tell you not to do that. Say, hey, if it goes good, we're at 11. If it goes bad, we're at 8. That's reality. Because people know that there's going to be difficulties and problems. I think the biggest thing with the investors is just be upfront as you can, because that way they feel more comfortable. And also, little things like, if it's a couple, you need to pitch both of them. Because if you pitch one, you really don't have the wife on board. A lot of these are their life savings. They're making these commitments. So you want to get both of them comfortable with the situation. Be extremely quick to answer their questions and get back to them in the beginning. Because even though you have a life and structure, they think you should be at their beck and call. So.
Yeah, like you said, it's their hard-earned money, and a lot of times, at least for our group, we try not to take more than 10 or 20% of their entire savings, because we don't want the extra pressure of, somebody's entire life is at stake with this project and whatnot. But I want
You
to
have
say
a,
thank you for coming on the show. I think we're
okay.
running low. I don't know if there's anything any last words that you want to say, but you've been fantastic. I had no idea that just my LinkedIn account would create a connection where I could have somebody on the show of your caliber. It's been phenomenal having you on here, and hopefully I'll run into you at one of the IMN events.
You will. I'll get you the links so that you can talk to them. And whenever you need to do it again, and don't feel free to call and ask if you have any questions. We're glad to help answer them if we can, or if one of you guys runs into trouble, just tell them to call.
Amazing. All right. Well, with that, I'll sign off. Thank you so much for coming on the show. I look forward to
Thank
staying
you,
in
Ruben, for
contact.
having me. I
Yeah, you
appreciate it.
bet. Take
You
care.
got
Have
it.
a great day.
All right. Bye-bye.